Well, time for our quarterly rendezvous with the top management of TCS, and as always, it gives me great pleasure now to bring on board Rajesh Gopinathan. It's not NGS, it is Samir this time. And the reason why we got Samir and Rajesh this time, Rajesh must say time flies. 40 quarters ago, you took over as the CFO, and now there is Samir as the CFO.
Absolutely, Nikunj. First of all, very happy New Year to you and to your viewers here. Yep, time really flies. 10 years. I can't believe that we've been doing this every 13 weeks, week on week, every time. So I thought that it is appropriate, and we have never had a chance to do this together with you.
I know. It's exciting to have you both together. Rajesh, let's talk about the big picture first. We'll get into specifics. As you look into 2023, the year gone by, from your standpoint, would you say it is glass half full or glass half empty?
22 has been a very good year, Nikunj. So if you look at it in the context of where we have been in the last few years, 22 started very strongly. And considering that we are back to a kind of a pre-pandemic operating model, it has ended also quite strongly. So both the 4% in the Q4 of last financial year or calendar year first quarter and this quarter 2.2% growth. So revenue side has been very strong, and that's always an indicator of where the demand is and your relevance to your customer base. Of course, the year has also been of enhanced cost, and that has been a factor across the economy, and that has also played out in our side. So the profitability we would have decided to be a slightly higher, but on the revenue side, absolutely no complaints. It's definitely a glass that is very full.
Okay. So as we look into 2023, and if you have to talk about FY24, what are the feelers you would like to share with our viewers and with your investors? The idea is to perhaps understand, discuss and debate the macro concerns which everybody is talking about. Historical precedence has indicated that every time when world has slowed down, it has impacted IT outsourcing immensely.
Because the way to think about it is that the world is in a very diverse situation. Each market is going on a very different path, driven by very market specific issues. Though from a zoomed out basis, it looks to be similar. So if you go sequentially, Europe of course is going through a major geopolitical struggle, and that has its impact on business decision making, lack of clarity on where they are going. If you go to the other side and if you look at US, our discussions with our clients indicate that at a case by case basis, most companies are doing well. They are in a good place, business outlook is strong. Again, as I said, similar to us, cost has been high, there is increased focus on cost, but there is also the clarity that whether it is to restructure the cost base or to continue on that revenue growth journey, technology investments will continue. The near term, I would say that the decision making is on a bit of a wait and watch mode as to how does this whole thing come about. And I think some of that concern is imported from the financial markets rather than the real economy being in as big a concern as the financial market has. And the financial market is about asset repricing. It is not really about business outlook changing as much as the underlying cost of that asset being repriced because of the changes happening on the interest rate regime. So our view on the US demand side continues to remain positive, though in the near term, given that the talk is about the impact of the inflation, we believe that we need to be careful about what the near term view is. But as we go into the year, we believe that the actual outlook and the actual decision making will reflect the underlying business strength rather than the financial aspect of the whole numbers that you see out there.
Samir, I'm coming right back to you, but I do have a follow-up question on that. When you say that near term you expect a delay in decision making and then things to pick up. So for this calendar year, do you expect a tale of two halves? Little bit of slowdown in the first half which could get captured in this quarterly number, maybe in the next quarter, but eventually as the year progresses things would pick up?
I think that will be a good way to describe, especially the US side of the business. And I'm hopeful that it is only, in fact, a few months into the first quarter. And by the time we get to February, March, we should have a much better visibility. And we are quite hopeful for what the rest of the year is likely to be. But it is prudent to wait and watch. And that's the posture with which we have gone in. We are leaning forward, but staying very committed. As I said, we are staying very engaged with the customers, but waiting and watching to see how it develops.
Samir, I was looking at margins, and margins have exactly gone back to where they were pre-COVID. 25%, 25%. FY19, 25%. Last quarter, 25%. There was a uptick which happened in margin because of the business and the cloud migration. Now it's come back. Is this just a coincidence?
Let me first point out, we are at 24.5% right now. Our aspiration is to get to 25% as we exit this year. And as you rightly pointed out, through the COVID, there were certain discretionary expenses which did not take and we had a margin uptick. And then that was followed by a year where we had significant headwinds coming in. Headwinds in terms of the link to the supply side issues which we face, the entire churn, and that caused us to impact. We stayed focused on our execution and ensured that we get our trails back as we move towards it. And I think that has played out very well through the year. And yes, we are at, we should be getting towards the pre-pandemic level.
What is stopping you from getting there? Because it's easy to imagine that attrition will slow down. It is easy to imagine that wage hikes will come under control. Rupee is a tailwind. So what is stopping you from going to 25%?
Yeah, so we have progressed quite. So we called out when we had our results in Q1 after the full impact of increments in Q1. We are at 23.4. We have structurally moved towards 24.5.
I'm going to quote Rajesh from an interview, and Rajesh, you've gone on press, I think December end to the Economic Times, and he said that 2023 will be a year of margin repair, and we don't expect margins to improve by leaps and bounds, but directionally we are working on it. So when Rajesh is calling out for repair in margin, what is he indicating to?
Yes. So repair, what you see is ongoing, and what we have seen is through the last year, we invested significantly into building capacity. Rather than people, the entire industry hiring from each other, we invested into a talent pool and invested into their development of talent, training, etc. And that productive capacity is getting into the billable pool now, and that is reflecting onto it. And we'll continue to focus on our execution rigor, and that is what we mean by repair of margins.
I'm collating some of your public statements only, and again, what you've indicated that the business like TCS, even at this level, 5 years, it can actually double. Is it?
I kept myself the range of 2030 for that.
Yeah, 2030. But I'm talking about a long term view.
Yes, sir.
But for that to reach from where you are right now, I'm looking at about 6 to 7 years, the growth rate has to be between 9 to 11% for you to even double by 2030.
I think from where we said, so if you go at about 7, 8, 9%, you will get to that 2030. So that is, I believe, definitely doable, and we have the demand visibility. If you look at our client universe, today there are about 60 customers from whom we make, let's say, annual revenues of more than 100 million. If you look at our client universe, these are typically large global corporations. Their tech budgets will be upwards of $1 billion plus. So even in customers where we are their strategic vendor, our market share of their total tech spending is 10% or lower. And definitely there is a path towards consolidation. Even more so, if you take the top 2,000, top 5,000 customers globally, each of them will be of that size. And whereas we are only at about 60, so there is that market share gain to be had.
Are you growing because of market share gain, or the absolute pie is expanding?
No, we are going significantly on both sides of it. There is an absolute pie increase, so the overall tech budget and the tech spending universe in a good year grows by about 5-6%, in a bad year goes by 2-3%. In a good year we grow by 15%, in a bad year we grow by 7-8%. So there is definitely a market share gain. If you look at individual markets, for example, the UK market, in UK market now we are the single largest tech provider, and that clearly indicates our increasing market share. Similarly, in Europe, we have been systematically going up the charts. In US, the numbers are a bit more wider. We estimate that we are probably the number 2 on a like-to-like basis in the US market. So definitely there is market share gain, and definitely the overall market is expanding, and we are participating on both legs of that growth journey.
I'm going to ask this question on behalf of investors. Now, it's very easy for us to correlate macro and talk about IT spending. But if I look at the last decade, there have been good macro points and there have been bad macro points. But IT outsourcing in India has grown. Should we dismiss this entire myth which everybody has, that macros and IT outsourcing for a company like TCS are directly correlated?
Nikunj, there are two things that are worth, first of all, I agree with you, and there are two things to be kept in mind. One is that we need to think about IT spending and not IT outsourcing. Because today, if you are a large global enterprise and you think about an IT project, you will think of a company like TCS as an integral part of it. You are not going to think that, okay, out of this budget, I will outsource X and I will do X, Y here. So it is not based on outsourcing or it is about IT budget versus what your overall other cost side of it. So as long as there is an IT budget, we are participating. And to your earlier question, we are increasing market share of the IT budget. So that is the one driver. Second is that the way to think about IT is an industrial perennial. The absolute amount of spend might go up and down depending on the economic cycle, but it is inconceivable that IT will be actually deprioritized in any part of the cycle. There might be short-term decision making, a large project is kept on hold or it is delayed. But overall IT spending is such a perennial element that the specifics of what gets bought will change. It is very similar to on the consumer side, FMCG goods are perennial in their demand. The specific item that gets sold, whether a high value product or a medium value product gets sold, or the absolute incremental volume might change, but on an ongoing basis, there is perenniality in demand. The same perenniality in technology demand exists on the industrial side, and which is very different than what it was, let's say, 10, 20 years back. So combination of perenniality in demand, combination of a much better business model that allows us to increase market share, allows us to track slightly a few percentage points ahead of where the overall industry is going, and we have been able to actually, that gap increases in a period of stress, and in a much more gung-ho environment, supply side constraints come in, and sometimes the gap actually reduces, though the absolute is higher. So that's the way to think about it. In a bad year, tech budget goes down to a very low single digit. We still do mid or high single digit growth. In a very good year, tech budget goes to 5-6%, we do 15%. So
I have a last question with you before time runs out, and I was looking at our interactions and I was looking at the choice of words. Last year, the choice of words was agility, exciting, transformation, deal size becoming bigger. I'm looking at your interaction based on yesterday's press conference and right now with us. Wait and watch. Things are slowing down. Decision making is getting delayed. There's a different usage of vocabulary. Am I reading too much into that?
That reflects the CFO sitting next to me. I used to play that role 10 years back.
No, but the choice of words is different.
The way to think about it, Nikunj, actually a better...
It's not a profit warning, but the choice of words is different.
The better analogy is, it's a perfect test pitch. There is something in it for everyone. You got to play it session by session. But we are confident about the team and
is this a turning pitch? Is this year will be a turning pitch in cricket terminology?
It's a good test pitch. There'll be bounce in the day, there'll be turn in the day, but it's not going to break down. And that's the perspective with which we are playing.
Is the CFO confident of TCS scoring a double century?
Well, last time when the CHRO was sitting with me, you made me speak all is well. we are aspirational that all is well.
All is well?
We are aspirational, we are all is well.
Okay, wonderful. You can look at, endlessly about what has been a miss and what really has gone wrong. But the way I look at Rajesh and Samir is that, look, the relevance, what markets thought that was going to get subdued because of macro headwinds, at least that myth in a sense is getting challenged. So double digit growth, yes or no, you tell me, for next year.
We'll not get drawn into that, but it's a good outlook out there.
All right. Yep. Wonderful. Good luck for 2023 and thank you for joining us. I'm going to give it back to Anisha and Avan in the studio while we wait for NGS and for Milind.
All right, so that's the take coming in, and some of the key takeaways is, of course, that as of now the glass is quite full, and they are saying that they're maintaining the guidance on a 25% margin for FY23, saying that near-term decision making, as of now, that's in wait and watch mode. The long-term revenue target is foreseen at $50 billion by 2030. Let me bring on board Pankaj Pandey as well, who's joining in from ICICIdirect.com. Pankaj, good to have you on board. Just going by some of the brokerage notes on TCS this morning, it's a bit of a mixed bag. For instance, JP Morgan is underweight, Morgan Stanley's equal weight, and you've got Jefferies, which maintains a hold with target price at about 3,500. Just wanted to understand, given the kind of move that we've seen in TCS of late, what your outlook is on the kind of numbers that they delivered and how you're looking at the overall valuations allowing the stock to command its current market price.
Hi, good morning. Thanks for having me. I think the global macro backdrop remains sort of weak, so we are still not sure. But I think the overall TCS numbers have been quite positive. I have been tad better than our expectation, both in terms of revenues and margins. I think US order book also is more than $4 billion, so that is good. I think the growth areas or engine drivers continue to remain US and UK, so roughly 70% of your revenues are largely sorted. I think the only issue largely is the continental Europe, where the outlook is still quite hazy, which contributes about 15% kind of overall revenue mix. Our sense is that overall, while exit margins could be 25% this year, next year the margin improvement can be even more better, because normal historical margin range has been in the range of 26 to 28%. And with the US and UK sort of delivering well, both in terms of growth and also in terms of order book, we would maintain about low double-digit kind of a growth in terms of top line and bottom line. Previous rating for us was a buy rating on a forward basis of about 22 times. Lastly, there will be some tweaking of numbers, but overall we are looking to sort of maintain a buy on this particular stock. The report is yet to sort of come out, but overall, I think the numbers are quite decent. I think unless and until the global macro backdrop sort of suddenly does not improve, probably sideways movement in the stock is what we would expect in the near term.
Right.
But in the second half, our sense is that the stock should do well.
Sure, second half stock should do well, but one important factor in TCS's result was the fact that the net headcount actually declined by 2,200. What does this mean? How should we read through this? Nikunj will decipher all of that for us with NGS as well as Milind.
Well, Anisha, thank you very much. You already introduced the panel, NGS and Milind. Gentlemen, Happy New Year to both of you. Thank you for joining us. Anisha has also prompted me a question, that please ask Milind that why the headcount was negative. Is this an indication of what we should read into it? Because see, this is the guidance number which we get from TCS. And this is the only quantitative number which we get from TCS, which is used by everybody as a forward benchmark.
Okay. So, first of all, if you look at year-on-year growth from last quarter to Q3 of FY22 to Q3 of FY23, it is 57,000 people addition. That is point number one. Point number two is, that we have added a huge number last year, and also this last 2 quarters also 42,000 people. So basically getting them, hiring them and getting them to basically become productive takes time, and that investment is now paying off. That is point number two. And point number three is, obviously, like I said last quarter, we are going to drive efficiencies now going forward, even more so. And so all these three things together is what is causing the headcount down, and it has got nothing to do with demand. Let me just assure you one more time.
Now that you are driving efficiency higher and productivity levels will go higher, how does that change the structural wage bill?
I think think the wage, like I said, I expect it to continue the way we have been doing it in the past. I don't expect any significant changes from that.
Even at such a high iteration level, you are at different wage rate.
Yeah, but no, we have been able to again manage that also very, very well by combining a good mix of people coming in from the campus versus people from the market. That mix, managing that mix, continuously training people, continuously cross-skilling and upskilling people on these fronts is what keeps our cost at a level where we want to be at, and thereby basically one can do the wage hikes the way we have been doing it in the past. I don't see that changing significantly, but we'll play it by the year and see how the next 3 months go.
NGS, as we look at 2023, while the management of TCS has said that North America, no problem whatsoever, Europe is where the problem is. We spoke about it also last time. You said, look, some manufacturing companies and some European companies may slow down, which they've slowed down. What are the chances that the slowdown could be a prolonged one? And as we move into 2023, you may be forced to call out that the trend is much slower than what you anticipated.
As you rightly said, last quarter itself we talked about Europe. I think Europe is the most affected by the energy crisis as well as the war in both the counts. On that basis, that that uncertainty continues, and people want to be a little cautious to make sure that they tide over the winter, which essentially means January, February, and is 2 important months that they should tide over. In that context, they are conserving cash, number one. So in that sense that the discretionary spend on large deals, etc., they don't want to drop it, but they want to slow it down a bit. But at the same time, there is vendor consolidation, cost and optimization type of opportunities is something that they want to really see how they can accelerate it, right? So it's a mixture of on the decision side, large discretionary spend, they want to delay it a bit. On the cost and optimization front, how do I, is there an opportunity to optimize? Is there an opportunity to do things better? And especially because in the digital world, newer technologies, newer automation opportunities are emerging every week or every month, right? So they want to see that, look, okay, this is what you're doing, but this is a new technology that has come in. Can you employ this and disrupt our operations a bit higher so that, we are able to be more automation, more efficiency that comes in. So in that context, I think Europe is a bit cautious at this point in time, but I don't see fundamentally anything wrong, right, in either of these industries. Manufacturing, they want to just make sure, slow it down, conserve it, and make sure that they don't stop the factories, right? They can, how can they, especially process industries and all, if they stop it, then it becomes 6 months, it's gone, right? So they just want to make sure that they keep it running for a longer period of time with the lower throughput, lower efficiency, so that they don't have to stop the factories, right? Financial services, things like mortgages, property, casualty insurance, some of those things are all, taking a slower growth on that front. But otherwise, if you take banking, capital markets, insurance, capital markets is doing well, commodity side are doing well, supply chains solutions have been come out, a lot of localization is taking place. So there is enough opportunities to look at.
There are no deal cancellation whatsoever in any of the geographies.
We have not observed in our client base, we have not seen any deal cancellations per se. On the other hand, there have been vendor consolidation, cost optimization opportunities on the rise. Growth and transformations in UK, for example, amidst all the macro uncertainties that you see, is one of the finest market for us, grew by 15.4% this quarter, year on year. And at the same time, decision making has been faster because industry and the government wants to make a quick difference and see that, look, their agenda for the next 18-24 months from a growth and efficiency perspective is achieved very quickly. I think Europe will follow suit.
Last time when we spoke, and I'm going to quote you here, you said you see a strong possibility of a double-digit growth. Is there still a possibility of double-digit growth, or possibility has become a probability?
As a management team, we are always focused on that. I think that has been the statement that I've always maintained, and there is no point in saying that we don't want to focus on double-digit growth is not going to, it's like, shooting on my own feet, right?
Right.
So as a management team, we are focused on getting to that double-digit growth all the time. Barring certain really, uncertainties that play it, I think we should be able to achieve that.
It's also that time of the year where we are forced to understand the IT spends, IT budget, client indications, and what they indicate perhaps in Jan and Feb perhaps holds true for rest of the year if macros are decent. What is the sense there?
We have connected with all our customers. We have put feet on the ground, and we are working very closely with our customers. A good number of contacts have been made with the customers. I think that technology spend is largely secular, and that is expected to stay put. We have not received any adverse comments per se. But having said that, many of them have not finalized the budgets. The budgets, the clarity on budgets, where they want to spend, that will become clear, in the next couple of months, right?
Is it different from last time, or last time
it's
also
always
was the same
always
pattern?
the case. Always the case that while calendar year end, they will firm up the budgets. Typically, the visibility on where they want to spend, how they want to readjust it, that will become clearer to us in the month of January, right, or early February. Given that most markets have an extended furlough into January, and then the real work starts from 10th of January, right? Sure. So we'll have to wait for the next 6 weeks to get some clarity, and then, but I expect this to be largely intact.
There are a lot of structural changes which have happened in last 18 months. One of them is travel, on-site, subcontracting. So I'll start with the latter part first. Because of the business rush or sugar rush, TCS and other IT companies adopted a model of subcontracting. Do you see that changing? Do you see that coming back?
So you saw that our subcontracting cost has gone down in this quarter, and we subcontracting is a model which is core part of our business, and we do that based on the need, specific short-term need, and do that. But in general, the number was much higher because of all the other issues we had in the past years, including pandemic and travel restrictions. Because of that, I expect that the subcontracting cost to come down. But some of these things are also very decision driven based on that time of the need of what we need, that particular resource. So I think expect it to come down, but in general that's part of our model. So I not too much worried about the fact that it is if it comes down at a gradual level, it's good enough for us.
Are we looking at a new world? Because there was time when we would excessively discuss on visa, availability of H1 visa. We've not heard IT companies really talk about it and really mention it again and again. Is this a new world where all those old visa concerns are behind us?
So I think if you look at it, our model has been global for many years. We have actually been hiring globally, not just the people from the market, but also basically from the campus, across all locations, across all geographies. So our model is truly global for many years. Just the H1 situation has been not so good for the last couple of years, but we managed it in spite of that because of the fact that we had a global model, and that will continue. And we manage our costs also that way by basically having the right mix in that location as well. So that is working for us.
And just allow me to take a leap from your answer, and since you mentioned that deals which you are getting now are essentially centered around cost optimization, vendor consolidation. What does that mean? Because the earlier deals which you've announced, let's say in 2021 and 2022, they were centered around transformation and cloud implementation. That's a different technology. If you are executing a different technology, obviously there is going to be more butter in the bread, so to speak. Is this good business but a low margin and a tough business to execute?
It's a mix actually. What I mentioned was in Europe, the cost and optimization deals and vendor consolidations is one thing that's happening. In addition to the growth and transformation, where the decision making has slowed down. But in terms of other markets, for example, UK and US, we don't see that happening because there are vendor consolidation and cost optimization opportunities, and there are growth and transformation opportunities. As we see it, the overall deal pipeline and what the order book that we have, there is a very good, healthy mix of new technology work as well as some of the older technology work. In either of these cases, there is enough digital work that comes into play. So the overall business mix, the resource mix, and the project mix is what we need to get it right. And I think the pipeline we have and the execution model that we have ensures that we put the right mix, right location mix, right talent mix to achieve the desired revenue growth as well as the margins.
How do you see the competitive landscape changing for IT outsourcing stroke IT spending for this year? Because ultimately the benchmark for TCS is market share gain and also what we are hearing from other vendors.
I think we have the traditional set of competition that is always at play for either of these opportunities, whether it is growth and transformation or cost and optimization. But I think what we differentiate ourselves is superior execution and the way in which we have been able to bring together the collective TCS expertise, right? The full services of TCS, right? Because in these times, customers tended to prefer someone like TCS, which has got everything to offer, whether it is TCS Interactive on the giving the experience, the cyber security, the core cloud skills, as well as the overall execution rigor and execution methodologies to deliver it within budget and on time. And that's something that delivers the best customer satisfaction as well as the good revenue and margin results for us.
Milind, I'll wrap it up with one final question. Now, TCS is India's largest IT company, so whatever you will call out today becomes the benchmark for the industry and everybody would look up to that commentary. We've had an extraordinary demand rush and an extraordinary level of attrition. While you've called out at a TCS level that where attrition is headed, but for the industry per se, what trend do you see in terms of attrition and wage?
No, things are definitely normalizing. Things are definitely normalizing. Like I said,
let's keep TCS aside. I want the industry.
Industry-wise, I believe things will normalize. Things are normalizing because of we are already seeing it. I'm seeing it now. I'm seeing it. What's happening in the next quarter. All of that, makes me believe very firmly that it's not just TCS. Across the industry, things are normalizing.
What is your definition of normal for the industry?
It will come back to pre-pandemic levels in the next few quarters.
For industry, both in terms of attrition and where you see the year-on-year wage hike moving.
I'm talking about attrition right now. Okay. So attrition, I will talk about it for the industry. The industry, I'm seeing it. Okay. Wage hikes is obviously depends on every company how they want to do it. I'm saying it. We don't expect it to change, but we'll obviously play it by the year and decide in the next 3 months.
And just last question from you, really an industry-wide question. Whatever you will say, like I told Milind, becomes the benchmark now. You've given us hints on TCS. I want to be slightly more industry specific. Do you expect this year to be a challenging and a tough year for industry? Well, TCS has got levers why they will grow. We know the pillars on which this great company has been built. But for the IT industry per se, could it be a tough and a rough year?
I think I won't call it tough and rough, but I will say that it will be tough and smooth, right? The sense that, look, things that need to be kept going, people will keep going, and there will be further optimization. People will really advance their cloud agenda into what we call as Cloud 2.0 and Horizon 2 and Horizon 3 type of initiatives. The machine learning will define the future business models. People are really looking at machine learning. What does it mean to our business, right? And how I can really leverage the digital technologies and the advancements that we have made in cloud into redefining their own business models and ecosystems.
I'm tempted to ask one more question again, and let's clear the air. I don't want to mix words here. TCS management has aspirations that they want to grow at double digit. But does NGS see a possibility or a probability of a double digit growth? You're going to choose the word. Aspiration is your word, probability and possibility are my words. Choose between probability and possibility.
You have put a challenge at me, and I'd say I'm ready for that challenge.
But the word, sir, I'm looking for that word, probability or possibility?
Possibility.
Possibility. Really appreciate your time. Yeah. Have a wonderful 2023 ahead, and fantastic to have you on ET now back.
Thank you, Nikunj.
Thank you very much.